scheduled on me. There we go.
No, I went live. Go live. LinkedIn says you're not approved for LinkedIn Live. It's only available for a limited group of members. For more information, blah, 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 let us know, blah, blah, blah.
You're live, Nick.
Okay. Yeah, I know. I'm just going through all this, the garbage. It says I go live anyway. Yeah, that's it. So anyway, we're live. We're live whether they like it or not. Hey, yeah. Jim, since you're know all that stuff, should I run the intro again?
I can't do any of that.
No, should I run? I'm not asking you.
Oh, I think maybe. Yeah.
Okay, let's give it a shot, and then we'll be right back. We got to do our professional intro, and then we'll be right back. Okay, that'll work. The intro did work, and welcome to Financial Friday. We're going to be joined very shortly by Professor Beckett Cantley. Let me see if anybody's going crazy on my internet right now, because I'm just going to check the emails because he hasn't arrived yet. But that doesn't mean anything. But I don't see any. I don't see anybody who's going crazy on me right now, so that's good, I guess. Let's go back here. Boink. Okay, Gwen's on. John Powers arrived. There we go. So we'll add him to the stream. Boing. There he is. John Power, how are you doing?
Good. How are you?
Okay, yeah, we're waiting for Professor Cantley to arrive. I was checking through the emails to see if there was a panic button being hit or not by Professor Professor Cantley, because maybe he's going, well, I can't get on. It's my first time I've done this, and or it could be, I got to load some software.
Mr. Power, you're from one of the Dakotas. I forget which one.
North
Dakota, right. And the people that are doing well on COVID-19 is South Dakota. At least that's their claim to fame. Yeah, they don't have much COVID-19, But Professor Cantley actually specialized in the area of captive insurance companies. So we're going to be discussing captive insurance companies. When I tell my international audience about captives, some of them go, Blanc, never heard of it, and some of them have heard of it. It's kind of interesting because it's actually worldwide. Mm-hmm. Captive insurance companies aren't limited to the United States, but most people in their financial education will never come across a captive insurance company. It's almost like they don't even know what it is. Right. And the other topic we're going to look at is conservation easements. Now, in the world of taxes, conservation easements are big, they're huge, but outside the world of that world, what's a conservation easement? That's kind of it. Alexander Starr has just joined us from Canada. Hi, Alexander. Good to have you here. Yes, and
well, Nick, I don't see anybody protesting the free insurance. So
no, it's not free insurance, Jim. That's not how it goes. Captive insurance companies are a whole different cat into themselves. But in English, just to brief people before Professor Beckett Cantley gets on, what a captive does is this. People in the United States spend hundreds of millions, if not billions and trillions of dollars on insurance premiums. You insure your house. You insure your car, you have workman's compensation insurance. So the thing is, we have health insurance. So there's a lot of money that goes into insurance companies. As a matter of fact, they say one of the biggest insured group of people are the people in the United States of America. In other words, we buy more insurance than anybody else in the world. Mm-hmm. Okay, so the captive idea is, rather than sending your hard-earned premium dollars to the insurance company, you create your own insurance company. Okay. And then you send the hard-earned insurance premiums to the company that you own, rather than company that someone else has owned, that obviously has administrative cost and profits that are built in. And then you insure the risk, the underlying risk for the whatever you're insuring. A good example would be health insurance, although I'm not very familiar with that industry. I should have brought Tom Snell on, because that's the area he works on. Rather than paying the premiums to an insurance company, you pay the premiums to a company that you own and control that gives all the benefits. One that we were working on was, oh gosh, what was it? It was like homeowners, but it really wasn't. We were insuring buildings, hotels around the world. One of my clients owned all these hostels around the world. And what he wanted to do is, rather than pay an insurance company and insure him, he actually owned hostels in your city in San Francisco, Jim, as part of it.
When you say hostels, I'm thinking of armed people.
No, it's a hotel that's not a hotel that's not expensive to stay in. So the thing is, what he wanted to do is basically create his own insurance company, and then rather than writing the checks to the insurance company, write the checks to his own company. Now, the problem with insuring buildings in San Francisco, what risks do you have in San Francisco? Earthquake. Yes. And that's very expensive. And that was part of his problem, is insuring the earthquake risk in San Francisco. And we went and did the analysis on it. Listen, Jim, that's a very expensive risk to insure because that takes his whole bloody building down. Mm-hmm. And it's almost unquantifiable. You don't know when and where that's going to occur. But a captive, he would be able to write the premiums to himself, to his own company, and he can write the policy the way he wants it written, as opposed to the way the insurance company wants it written for you. And so that's the whole theory behind the captives. And then they exploded here in the United States. They've been done internationally for years, but then we created new laws that allow them to be here in the United States, made some very favorable tax advantages of them. Certain states started competing. I think Vermont was one of the first ones. Then other states, even North Carolina and Florida, joined in because you had to create and get a charter from the state to have your own insurance company and run your own insurance company. So they're not for everybody. In other words, Ma and Pa Dunbar investor, not really for him. But for clients that have businesses over 50 million that pay millions of years and millions of dollars in insurance premiums, it's something they should basically, take a look at as a captive insurance company. And Bermuda for years had been a big country of insurance and reinsurance. Reinsurance is very big in spreading risk. For example, like let's say a life insurance policy, because I work a lot with the life policies. In some of our companies, they will give you $1 million policy. So you see a policy from Jones Life for $1 million. What they do behind the scenes is they retain $250,000 if you die, and they'll pay that claim. The other $750,000 is what they call reinsured. They actually will pay a premium to another insurance company to pay the claim if you die. It's called reinsurance. And it's really important so that the insurance company themselves don't harbor all the risk of somebody dying. And a lot of the companies I look at what is their retention. How much did you retain that you're going to pay, and how much did you reinsure out? And they'll have treaties, they call them reinsurance treaties, to send it somewhere else, like in Bermuda. Bermuda Re will handle the claim if something happens. And that's been a big industry for years. Switzerland also has a big reinsurance market, Swiss Re, and they do it in life, and they do it in anything that there's risk involved. AIG, the American International Group that we're all familiar with, if you're not, you should be. They almost took down the entire economy in 2008. Okay, because I knew, who did I know? I knew the president of AIG. I knew him when he was what they call a regional years ago. And what happened is, the guy was a very interesting person, obviously. But what happened with AIG, they were selling off what they call derivatives. But basically, a derivative was this: these variable life and variable annuity contracts would have what they call a guaranteed minimum income benefit riders, which means that if you bought a variable annuity and it didn't perform because you invested unwisely in the market, you could annuitize it with a guaranteed rate. Back then, it was pretty high. The GMBI riders were 6% per year. Okay, what's the problem with that? The insurance companies weren't stupid. So what they did is they actually took that risk that they couldn't get 6% per year. Now I'm going back 10, 15 years ago when, the markets were making 10%, a year. Not the markets, fixed instruments were like 10%. I had CDs at 10%, you know. So what they did is they took a quarter of a point. And what they did is they purchased reinsurance from American International Group. And AIG sold billions of this stuff, literally. You know, and the guy who was, it was AIGFP in London was selling it like crazy. They call it AIGFP, a subsidiary company, American International Group, selling you these derivatives. And the insurance companies I worked with, like Principal Financial, Transamerica, because we handled all the actuarial work for pension plans of Principal. We had an exclusive, all their plans west of Mississippi. Okay, so the CEO, Barry Griswold, who's since passed away, was telling me, well, you know, we sold it all to AIG. Okay, fine. As we know, in 2008, the market crashed. All right. And they were going to go to AIG to pay the claim. What was the problem with AIG? They didn't have the money to pay the claim. Okay. Now here, this is the reason what the bailout took place. It was $700 billion back then, which you notice is nothing today. The problem is they weren't the only insurance company. Almost every insurance company in the United States went to AIG to pay money, what they call a derivative, basically paid a premium, saying, well, if it doesn't perform 6%, AIG will come and step up and take it. AIG, let's say, doesn't pay the claim. That means Principal goes under. Transamerica goes under. Every major insurance company in the United States fails because AIG fails. So here's what happened. They went to Washington, D.C., and they got together with Jamie Dimon, who's the head of Chase. They got all these guys together in a room and said, hey, we got a little problem here. We're about to have what they call a global meltdown in the financial markets because
too big to fail.
Oh, yeah. Yeah, but we never really went through that. But this was a very realistic problem in 2008. If the government didn't prop up AIG, then and AIG went under. They hold the breadbasket to Principal, which is a $500 billion company, not a small company at all. Transamerica, which is owned actually by a group in the Netherlands. And then all the other insurance companies, and they all fail like dominoes, doom, boom, boom. And then they have to go to the state insurance commissioners to, once they go under, they go through what they call rehabilitation. They don't go through bankruptcy. It's rehabilitation. Rehabilitation is bankruptcy. It's just a nice name for an insurance company that just tanked. And they have to say, hey, you know, we don't have the money. You got to pay it. And then they go back to the taxpayers. In other words, you have this this huge economic meltdown. So this was the problem back in 2008 with the insurance industry, and theoretically could still exist today. But and that's the reason you're right. This whole concept of too big to fail is what we're discussing now on a captive, which we're going to look at as soon as Professor Beckett Cantley arrives. I hope he got the time zone right, but I think he lives in Atlanta. No, he's in Las Vegas. Wonder if you got the time zone wrong. I think I said it was EDT. The thing is, what we're going to look at is captives. In other words, how you basically manage captive insurance companies, because a captive insurance company, all it is a microcosm of a large insurance company. Now, with that, John, you've had some experience, I believe, in working in captives. So maybe before the professor arrives, you can give us a little bit of experience in the captive areas, and that's what it's supposed to be about today.
Okay. You summarized the idea behind them. Captives have been around, as you said, for a long, long time. Excuse me. I would say probably 98% of the Fortune 500 companies have a captive insurance company to reinsure risk, or to self-insure some of that risk. They became more popular when there's a code section that I remember it's 831B that said that if you were an insurance company with originally I think it was 1.2 million of premium income. Now it's about 2 million of premiums in that section. But if you had premium income under that 1.2 million, you could elect to not pay tax on your profit like every other business does, but only on your investment earnings. And so that became, that's a huge tax break for those insurance companies. So what we started to do was people were forming captives, intentionally keeping the premiums under that 1.2 million, and to take advantage of that, that tax loophole. And then and then promoters would set up and sell. Sometimes they're referred to as cells, but you would buy a portion of that company. So I would put in $100,000 of premium, and you would put in $100,000 of premium, keep it under the 1.2 million, but we get the deduction for that. And then at the end, the other tax advantage is you're getting an ordinary income deduction for the insurance premiums. When it's run its course and you liquidate the company, then it comes out as a capital gain from the liquidation of the company. So that was kind of the beginning of those micro captives.
Very interesting. But Nick, I have not gone through bankruptcy, but I have gone through multiple rehabilitations, and I just wonder, when I emerge from rehabilitation, am I whole again, or how does that work?
Oh, on the rehabilitation, if it's an insurance company rehabilitation, they've made everybody whole so far because the state insurance companies all have guarantees. State insurance guarantee funds. Now, I'll tell you something interesting in the state insurance guarantee funds. Insurance agents are prohibited by law to tell you about the state insurance guarantee fund. It's a weird thing. In other words, let's imagine I'm from Jones Insurance Company. I tell you about this insurance policy you should buy, but I don't know anything about Jones. Well, Jones is a C-rated company. But don't worry, we're backed by the state insurance guarantee fund. It's illegal for them to tell you that and the amounts that are backed. However, if you want to know about your state insurance guarantee fund, you just go to the state insurance guarantee fund website. Every state has one, and you can learn about it yourself. I find this fairly interesting. I understand the reason for the law. Here's the real reason. A company that's rated A+ by Best is competing with a company rated C by Best, and the person by C, the agent, has a ability to tell the client that, hey, look, we're just as good of a company as the A company because we're both backed by the state insurance guarantee funds. Ratings mean nothing. You see what I mean? And that's the reason why they don't want they say there's a law out there that prohibits them telling about the state insurance guarantee fund. So it's just one of these weird things in the law. In other words, where you got to keep your mouth shut about something. Now, as an attorney, I have a real problem with that. Okay. First of all, I don't have an insurance license. So, and I'm not selling the insurance. That's what the agent's doing. So I'm going to tell my client about the state insurance guarantee fund, because it's something that they do need to know about, because every state has one in the unlikely event the insurance company collapses. Now, insurance companies do collapse, but they're usually so small, off the radar, and a lot of them are picked up by other insurance companies so fast that you don't even see it happening. So, and what really is going on, Jim, is they don't have enough what they call reserves to meet future claims that the actuaries calculate. So, and everything insurance is, I got to pay these future claims. How much do I have in reserves? If the reserves aren't sufficient, then they say you're going to have to merge or sell or go into rehabilitation. And that actually took place with Mutual Benefit Life back in 1993. They had bought real estate in Fisher Island, Williams Island, Florida. Fisher Island, what a horrible investment. By the way, it's only the wealthiest district in the world right now, maybe even more expensive than Tiburon or Belvedere, those places out there. I'm not kidding. Go Google Fisher Island. It's really expensive. It was owned one time by Mutual Benefit Life. But what happened, the regulators were saying, they got a $3 billion call by the New Jersey Hospital Authority. And the regulators saying you don't have enough money. You're too illiquid. You're going to use all your capital just to pay it. And hence, you have to go into rehabilitation. So Hank Cates took the whole company, sent it to the state of New Jersey. They went to rehabilitation. Oddly enough, just like that and with Executive Life, there were sufficient assets given time to pay the claims and then some and be extremely profitable. But it doesn't matter because there was some political winds that were also sailing at the time that took down executive life. One of the political whims, the New England mutuals did not like executive life competing in the market space. You see, so if you're with another insurance company like Northwestern, the last thing you want to see is executive life paying these big dividends. So what happens to mutuals have a lot of political power, which you found if you work at the NAIC, the National Association of Insurance Commissioners. And so the political winds brought down Fred Carr, Jerry Schwartz, and the whole executive life team. Splat. Mutual benefit, they just had a lot of enemies. And so there was no one who was going to pick up their tab. And so what happened, they went into rehabilitation. So Nick, it does happen.
Who knew that insurance was so complicated? But I want to talk about these these state guarantee funds. Like, who pays for them?
State insurance guarantee funds are paid by premiums on your insurance policy. Okay. In other words, the thing is, a lot of the insurance policies have built-in costs. One is what they call, there's a deferred acquisition cost, which basically is your commissions, but also they have other things that are taken out. State premium taxes are also taken out. Some of it you don't see, some of it is disclosed. Today, most of it is disclosed if you ever bother to read it, but you'll see state premium taxes are being paid out. And the other part is your friends at your state legislature fund it. So the thing is, they are funded and backed by the individual states. So all your policies will have something like that on there.
By the taxpayers of those states.
Ultimately, it's the taxpayer of the state. I mean, at the end of the day, so that's kind of what happens. So apparently we have a technical problem with Beckett. He was on at 107 and couldn't find us. I sent him a link. I sent everybody a link. So I'm going to have to he wants to redo this for next week. That was the latest thing that came out. Let me see if he can find his way on.
I don't know if I can carry the whole show myself, Nick.
No, I said we're on waiting for him. I'm assuming we're off for a day going back. No, we'll probably have to go postpone this and do this next week. He goes, I'm happy to participate next week. So apparently there was a technical problem somehow.
The first technical problem we've ever had on IBM TV.
No, it's not the first technical. And frankly, Jim, it won't be the last. But somehow he goes here. 107 EST. I'm assuming we're off for a day. I'm going back to work on my articles. Happy to participate next week. Let me know. Have a great weekend. Okay. And I was going like, oops, he's working on law review articles. So all thanks.
So let me get this more personal.
Okay. I'll just tell him. I'll tell him we'll meet next week. Okay.
Yeah. Mr. Powell, has North Dakota ever gone through this? Has North Dakota ever had to do state guarantee for an insurance company that has gone under?
Oh, I'm sure they have. There's thousands of insurance companies. Some of them very small.
Yes.
So I'm sure they have. The most of those insurance reserves, they have caps on. So I think it's on an annuity. Is it 300,000, Nick? Or is it
you mean in the guarantees? That's very interesting you say that, because it depends on what state you're in. For example, in the great state of Washington, they insure annuities up to 500,000. In New York, it's 500,000. In California, 80% to a maximum of 80% to a maximum of 100,000. In other words, they don't give you your full boat in California as one of the weakest around. So it really depends what state you're in, how the annuities are guaranteed. So if I live in some state, I'll have a 300,000, probably in South Dakota. Most of it is 300, John. So most states are 300. Mm-hmm. But if you went to California as one of the weakest state insurance guarantee funds in the country, the weakest, if not the weakest, it's one of the weakest. Right. And the strongest are Washington, New York with 500,000. But you have to go look at your own state insurance guarantee fund. What it says, if you go buy an annuity contract, which is really a CD buy-up insurance company, basically, that the state will guarantee the principal up to 300,000. Right. So and probably in North Dakota, it's probably 300, I would just guess. But that's one reason I always refer clients or people who are listening to go to your state insurance guarantee funds and see how much they will back the insurance company. But you're right. The failures take place all the time, but they're small. And the captives I worked with, John, what they did require is a charter to be filled out. I don't know if you had to go through that, and they required accounting and actuarial work to get the charter. They just didn't give the charter away. Did you experience that at all?
Well, the ones I worked with were already set up.
Oh, they already had their charter. Okay. Well, what happened when the tax law came out that was very favorable, and you got big deductions for paying premiums. I think you could write off 1 million, 1.2 million. Write it off. Now think about it. This gets Alexander's attention. A tax deduction of $1 million or $1.2 million. And all you have to do is have your corporation write a check to your insurance company. Now think about that one. So you create your own company, and your company's making money. And I know, Jim, this is mind-boggling for you in San Francisco. Okay, this is tax law 101. Okay, I got a company that's making, $700,000 a year profit. At the end of the day, John's going to tell me you owe a lot of taxes. And I'll tell John I don't want to pay those taxes. What can I do? Create your own insurance company. What? Well, you take the $700,000. Now watch this, Jim. The magic of David K. Johnson. I'm going to see if I can get him on here. I'll have a fit with this one. He'll love this one. You take the $700,000 in your profit, and you write a check of $700,000 to your insurance company. So it goes from here to here, and then your taxes go to here. Zero. Seriously. Okay. Now, it might sound too good to be true for the naivete, or especially for the regular people that are sitting there paying income taxes and Social Security taxes. Okay. But for corporate tax planners, it's like, why not? It's a $700,000 write-off, and you just save the client $300,000 taxes. It's like a no-brainer. And this is part of the reason why when I talk to some of the people that are working for a living, they don't understand that this is what's going on behind the scenes. But I think it was you, the one, John, weren't you the one saying that there was like one line that says, gross income is income for whatever source is derived, and then the rest of the code is all about how you get deductions and credits.
1% of the tax
code.
Yeah, right. Tax.
Yeah, right. In other words, the thing is, if you ever read the Internal Revenue Code, there's one line, I think it's section 61, that says income is from where it's derived. And then the rest of it is how you get deductions, exemptions, exclusions, and everything else. That's where all the meat and potatoes are. Okay, so Jim, here's where the meat is. Okay, now if you have a private foundation, there's meat there too to bury your sins or your taxable income from Just for Dummies. All right. But how you bury the taxes for large taxpayers or corporations that want to minimize the tax liability is the captive insurance company by moving it line item A over line item B. But then the captive is also governed by rules and regulations. Now, and this is why I want to get Beckett involved in getting into some nitty-gritty details. He'll be here next week, it looks like. I'll have to, I think happened. I gave him the link through his email through LinkedIn, which may not be as effective, and I got to get his direct email. Something so stupid like that could have stopped him from getting the right link, because all I can think of is he got the wrong link. Otherwise, John wouldn't be on here.
Well, we can blame Russia on that, can't we?
Yeah, we'll blame Russia on it. Yeah, we got intercepted somehow, but we'll get into that next week. So this will be Captive 101, and then we'll have Captive 102 next week. Okay. But the thing, and I know, like I said, I know a little bit about it, and so the thing is, Beckett writes law review articles, and he swims in it and all this other stuff, and the devil's already in the details, and my little knowledge is just what it is, but I would say that the general public and the average viewer that's watching IBM TV probably knows nothing about captive insurance companies. They're going like, what's a captive? Not let alone
didn't sound good.
What?
It didn't sound good. Captive didn't.
It didn't. No, it didn't sound. It doesn't sound good. But captive means the corporation owns the insurance company. Now, what John pointed out, which is absolutely true, 98% of the Fortune 500 already have a captive.
Yep.
Okay. In other words, if you went to Microsoft, they already have a captive. You go to Google, they already have a captive. You go to all the Fortune 500, they have one, which means there's no new business there to do it. So what happened to encourage more smaller companies? They created this whole concept called the micro captive. So it allows you, Jim, or you, Alexander, to wipe away the sins of taxation through owning your own insurance company. Now, Alexander, since you live in Canada, it's probably not an issue, but in the United States, it is an issue, because taxation is. Yes.
I'm not sure how this works in Canada, really.
Yeah, I'm not sure how it works, but the
But
Canadian
just-
companies will have captives also
would
for the
imagine.
same reason, to ensure, because almost every company in the like I said, 98% of the Fortune 500 already have captives, and they'll have captives for business purposes. So I'm sure there are in Canada. I just don't know if they have micro captives, which allow smaller businesses to actually set up a captive and run it profitably for them.
So just Nick, continue to your example when 700,000 check is written to your own insurance company.
Right.
Then once money in the insurance company of your own, $700,000, what's happened with this money further? What you investing and
Yeah, you invest it. Yeah, right. And you can
Okay.
invest it. Now, again, the rules have changed since I played with this. That's the reason I was going to ask Beckett, because he does all the time. You're actually be able to invest it. And when I was playing with it, the earnings would be tax-free or tax-deferred. So you basically had your own tax shelter, for the investments in your own captive. So it was really a pretty cool device. The rules have changed since then. That's the reason I wanted to talk to Beckett about.
Okay, if you need some money out of the 700,000 plus minus your investments, whatever they were, back in your business, just part of its money, say 300,000, you want to get back to your business, and business would have to pay tax from just 300,000 then?
Maybe. It's always a maybe, because see, it's always the devil's in the details. Let's say, Alexander, you go, but I need 300,000 in my business. Okay, no problem. We'll lend you the 300,000.
Okay, so then it's a loan.
It's a loan, right. And then the loan. Okay, so look at the magic of corporate tax planning. Your own corporate entity that you own and control lends money to your profitable entity, which has taxes, so you got the money back, and you pay interest back to your corporation and you deduct it. Yes. So the thing is, it's a win-win situation. Microsoft loves this so much and these concepts. That's the reason they did the double Dutch Irish sandwich. And so did Google, where you live, Jim. The double Dutch, very similar type of concept. And the client that I worked with on the captive actually had a double Dutch already. So I didn't get to do that for him. It was already set up. But the thing is, they love it so much, they have 400 corporate tax attorneys full-time working in Redmond. Not one, not two, not 10. Think about it.
Yeah.
400 corporate attorneys work in Microsoft. Because I used to go play chess with the Microsoft people when I was living in Seattle. So they go, hey, how come you don't work here, do you? No, I said, I'm just a guest, stuff like that. Well, you beat all us Microsoft days. Yeah, it's kind of amazing, isn't it? And I'm not even an engineer. Yeah. But the thing is, then you know how to play chess. But the thing is, they had 400 lawyers that would work on it, because there's issues like that go on the time. Now, when you go to probably Jim, does your average voter know anything about what I just described?
I would assume not.
They probably don't even have a clue.
No.
But, and then the thing is, this goes on all the time. And so, like, next week, the two areas we're going to discuss with Professor Cantley is that and conservation easements. Now, I didn't do a lot of conservation easements. So, my knowledge in that is very, very limited. I don't know, John, did you ever come across the conservation easements or
I've used them for a couple clients, yeah.
Oh, yeah. Well, then you would be better than I would. Describe what the conservation easement is to our audience so they would know.
Okay. A conservation easement is just an easement that's placed on a piece of property, whatever it might be, that, the easement restricts the use of the property somehow, and you don't sell your property, you just put an easement on it, and then you get a deduction for the calculated reduction in value, because if you have a piece of property with no easement, you have a piece of property with an easement on, or the property with the easement is worth less because it can't be developed. And so you get a charitable contribution deduction for that easement. Very common. They were very. There's been a lot of abuses. They're very common. There's hundreds of thousands of these.
Right. I mean, there's a lot of them. Okay, this is the way you create deductions. Okay, so Jim, it's like you own a golf course and you have money coming from Chess for Dummies, and unfortunately, you can't stop the income for Chess for Dummies because you're a popular author. Okay, but we could do is say the golf course. Yeah, you see, there's no way. I'm not sure how you do an easement on that, but the golf course you want to give to charity into perpetuity, or you're going to make a claim that you'll never develop it. It'll always be used as a golf course, and give somebody an easement to that, and then you get a write-off based on the value of the the charitable deduction that you gave.
And in the case of the golf courses, there was principally you would put an easement on a portion of the course, for example, that's water hazards, or is rough places that you're never going to develop anyway because
right.
Yeah.
Right.
So
yeah. Places. Okay. Yeah. Right. There's a bunch of trees on the course that you're never going to develop anyway, but you're going to use it as a tax deduction. So you do an easement saying, I'm granting into perpetuity that these trees will stay here as trees forever or for a period of year.
You think this has been done at Doral?
What?
You think this has been done at Doral?
Oh, it's done in many, many places. It could be. By the way, it could be. In other words, what the real problem is the average American taxpayer doesn't even know that this game is played all the time. In other words, conservation easements and captive insurance companies, that game is played all the time by everybody that knows about the game. And what it does is generates a deduction for the person who gives the easement away. So if you own property and you have some worthless land, but you don't want to sell it, what you can do is say, well, I'll put an easement here that this part of the land will be used in perpetuity, not to be developed. And you had no intention of developing it anyway. Right. So, and then you get a deduction that hits your income tax returns, and you benefit from that. So it's been a big play on there. What I find out is that a lot of people out there don't even know the game is out there. It's like saying, do you know there's a game called chess? And no, I didn't ever heard of it. And that's the tax game that exists in the U.S.
But Nick, when I'm going to go vote next time in November, there's going to be people to vote for, and then there's going to be measures on the ballot. I can vote yes or no, up or down on a school bond or something like that. But I've never seen a measure to talk about, money that goes to easements or the captive insurance companies or the state obligation to back them. So none of this is presented to the voter, to the taxpayer.
Really? No. Well, it's nothing that is hidden. It's let's see where. Oh, here it is. Oh, Jim, it's in the Internal Revenue Code. It was passed by your legislatures. Right. In other words, the thing is, I'm not saying anything that's new or exciting or behind anybody's back. Right. It is in the Internal Revenue Code of the United States of America, passed by the legislatures that you voted for.
So if I'm understanding correctly, and I think I am, the average voter has to know what you're talking about, has to know the IRS code?
Well, they should know certain provisions of it, of course. I mean, they pay taxes all the time, but
those I think we know about.
Yeah, I mean, the thing is they should know what goes on out there. But what I found, the average voter is not even interested in knowing all this stuff. Think about it. Okay, 50% of the people that vote work for a company if they're lucky today. All right, they work for what they call a W-2 income wage. All right, do they even have the financial ability to do a conservation easement? See what I mean? Probably not. What about doing a captive insurance company? Definitely not. They don't even own their own corporation. So it's not even an interesting concept for half the population of the United States. You go into the 90 percentile, and most of them do not have the financial ability or the the acumen or the to execute either one of these transactions. Now you go to the top 1%. Well, we've already been there. 98%. Jim.
They can hire 40 or 400
corporate attorneys. 98% of the Fortune 500 already have captives, which is one reason I was looking at, okay, this is great, but this has been there, done that. There's no opportunity for an entrepreneur attorney to get involved in captives, at least with the Fortune 500, because they already have it. You see? Now, but what they did is they opened up the market to the next Fortune 1000. When they opened up the captive insurance companies for basically small companies, and that's where a lot of the captive industry has become very robust, is in that. And with conservation easements, that's the reason you go see good CPAs like John. If you need a conservation easement, you go, hey John, I got this property and I really need a deduction, and I'm really having a rough time here paying taxes, and then he guides you through these processes. I mean, that's the reason you have good CPAs and people that know about this stuff, but it is not meant for everybody.
We were talking about the average voter being ignorant, but there's a difference between being ignorant and nescient. And nescience is just, you can't know everything.
Right.
And so the voter is just, this doesn't apply to me. Right. It's too complicated for me.
I agree.
I'm just not going to know about it.
Right.
And that's what we're talking about, something that's very complex.
Yeah.
That you have to study a great deal to be able to take advantage of. And even if you were in ability to take advantage of, you still have to hire somebody to do it for you.
Yeah. Yeah, I mean, you might be right. It's a very niche audience. I understand that. Yeah. But let's even go look at the top 1% in the United States. Remember, the top 1% income exceeds 800,000, has a net worth of over 8 million. And I'm probably being on the low side. Okay, but if you want to be in the top 1%, you got to make 800,000, have at least 8 million sitting around. How many people qualify for that? 3.3 million people. You see what I mean? So it's still millions of people in the United States that this applies to. It's just a different demographic. That's all, And so the thing is, things like this are interesting for them, but for 99%. Not that interested, and you're absolutely right.
How does it affect me?
Well, if your Chess for Dummies ever became a super seller, then it would affect you.
I'm an average voter. I'm an average citizen. I pay my taxes. This discussion of all this complex subject is is it relevant to me at all?
Let me think. John, I'll let you answer that question. What is the relevance? I mean, because you have to deal with clients on issues like this. What is the relevance of this to the average taxpayer?
I guess you could say that the relevance is it's part of what affects our deficit and things like that. I mean, it's available to anybody. It's like any provision of the tax code. It's available to anybody.
Right.
It just doesn't make it doesn't make economic sense unless you, as you pointed out, you're very high income. So I guess you could say philosophically it impacts you because it's money that's not going into the treasury.
Right.
Yeah, more than anything. But then there's always reasons behind conservation easements were to actually
conservation.
Yes,
I mean,
encourage
there's
conservation.
Millions and millions of acres that have been preserved because of these conservation easements.
Right.
So
it could actually affect you positively because the reason why those forests exist is because of the easements that you don't know about that were granted and some guy got a deduction on it. Captive insurance companies, this was the reason I read a long time ago. The reason was to lower the insurance premiums of the small and medium-sized companies and to create a robust, more competitive market. Because even the analysis I did, let's go to that earthquake insurance, it was priced here when it probably should be priced here. You see what I mean? So he could afford it priced here, but he can't afford it priced there. And so, and even the ability to offer that insurance. In other words, a lot of places he can't go to get it. Okay. And this is a big problem. So he's got this hotel in San Francisco. He can't even insure at any reasonable price, which means when it collapses because of an earthquake there, guess what he's left with? Just rubble. Yeah, you see what I mean? So the policy.
Where are the market forces working on this? This is the part I'm having trouble wrapping my head around.
Well, the market forces is they induce people through the tax code to move that direction. And one thing is like that. Imagine everything is taxed, except we get deductions for all these things that support public policy, conservation easement, supports public policy.
Yeah,
As what
I'm all
John
about
said,
that.
it keeps the forest there. It keeps
Yeah.
the land from not being developed. So what happens is the code puts in all these things that purportedly support public policy. The abuses take place when somebody, like, you're living in your house in San Francisco and you go, I need a deduction because Chess for Dummies is making too much money. So what I'm going to do is grant an easement to a charity that my house in San Francisco can only be used as a condominium. Then after I'm dead, it's going to be used for something else, for some other charitable purpose, and you get a big tax deduction for that. You see what I mean? There are ways that people do that. I don't know if you know that. They sell what they call remainder interest. So that what you do is you give away your remainder interest when you and your wife are gone to a charity, and you upfront the deduction today. And it serves a public purpose. It's going to go to the Eid Foundation when you die. And you get a deduction today that you offset with the income that comes from Chess for Dummies. Now, why would you do that? Well, you control the foundation. And by the way, foundations are used quite often for these plays.
That's why I'm listening.
Okay. So what you do is you sell your remainder interest of your house to the foundation. Okay. Then what you do is you get a deduction now and you stick it on your bloody tax return. So when the money comes in for Chess for Dummies, it's offset. Now, there's the devil's in the details, and you hire a guy like John to work through the details. I don't do those details. I go see a CPA on the details. But some of the details might be, well, you're limited to 10% of the charitable deduction because it's a foundation and it's a remainder interest reduced by another number. Then you got to fill out all these bloody forms, that you don't even know exist. To do that. And but that's basically what it is. What you do is you got to work through the paperwork and the details, but then you get the client from where they are from where they are to where they want to go, which is to lower their tax liability based on earned income for the crazy Chess for Dummies. You see what I mean? And then you operate that. And if you,
I don't think I'm going to do it, but I think I get it.
Okay, yeah, you may not do it because you get it. Okay, because the private foundations. And I don't know if you have a private foundation or a foundation. The Eid Foundation, if it's a private foundation, has been used as a tool to escape estate taxes for years, decades. Because it's just like Bill Gates. Why does he have a foundation? Well, he does have some charitable intent. But number two, big reason, when him and his wife die, because there's an unlimited marital deduction between him and his wife, when they both die, and he leaves $100 billion to the foundation, okay, which is a charitable entity. What does he pay in federal estate taxes, John, for his gift to his foundation at death? 0. Escape completely the federal estate tax. See what I mean? So that big federal estate tax is out there. Ooh, it's 40%. Just gone. I know his attorney is Alan King. I think I was working with him on the estate matters. I'm trying to remember the law firm he was with at the time.
I'm making a note to call my guy.
But anyway, those are the ways. That's kind of what you do. And so the thing is, you encourage other people. Now you did the right thing. Encourage people to make gifts to the foundation while you're alive. Why? Because you generate the tax deduction now to offset your income. Why wait till you die? Now, when you die, you get the deduction on your estate tax return, the Form 706. So when he dies, you fill out 706, all went to foundation, poof, disappears. But as he makes gifts while he's alive, he'll get current income tax deductions as well as it'll be excluded from his estate. So when he sat with Warren Buffett and I wasn't there, he probably said, "Hey, Warren, have you thought about giving your money away while you're alive?" "Nah, why would I do that?" "Because you get a tax deduction." "Well, I was going to do it when I die." "Why don't you get an income tax deduction now?"
If I do that, Nick, I'm going to get audited.
No, you won't. It's not a diff or a TCMP audit issue. You're thinking about your diff score, right? Okay, it's not going to affect your diff score.
I think if I gave money to my foundation, which I had done, and deducted it from my tax, I think it would be a red flag to the IRS. And I think I would get them.
There's no red flags. It either affects your diff score or you're part of the TCMP audit. TCMP is your random audit, okay, which won't affect it at all. So we're going to get diff score is there a certain box like home office deduction that brings up your diff score? that if your diff score continues to go up, then you're pulled for an audit. And I'm not sure if that transaction, if there is anything that would bring up your diff score. I'm not sure. In other words, I won't find one way or the other on that. But is it common if you have a legitimate foundation and it is, you got your 501c3 status or foundation of maybe 09. Okay, you already have your foundation. And it's 501c3. Okay.
Yeah.
Right. Okay, because foundations I thought were under Section 509, but I'd have to go back and look at it, a private foundation. But and you have to look at some limitations, because I think on gifts of charities like 50%, foundations maybe 10% or 20% of your AGI. So you got to go look at
private foundations are 30.
30%. Okay. He knows it right off the top of that's the reason to work with good CPAs. Okay, because right off the top of their head, 30%. Okay, so you take your AGI 30%. Okay, and that's the amount you can give to your foundation every year, deduct it. And yes, it moves from one hand to another. What's new? Okay.
But that won't trigger an audit.
No, it won't. No. I mean, the thing is, I'm shocked and dismayed that you're not doing this already, Mr. Ead. Shocked and dismayed. Oh, I see. Wait a minute.
I was warned.
I'm sorry. I'm sorry.
Audit.
You're from California and you believe in making large contributions to your state. So I apologize.
That's correct.
But for those who want to retain assets for themselves or the use of the foundation, good. But I know you'd rather
and not pay fair share of
you would rather send it to your friend Nancy Pelosi, who'll send it to somewhere else rather than send it to your foundation that could benefit.
I understand that my money is not going.
So the thing is, this is your decision. It's a free country. So if you want it to go in your foundation and you want a deduction and you want to lower your taxes, you have to think about working with guys like John who know the foundation rules off the top of their head and follow the bloody.
You might fire my guy.
I don't know who your guy is, but I'm shocked and dismayed he didn't tell you about this already.
No, he did, but he told me that I would also get audited.
No.
Okay.
I have not yet been on an IBM TV show where I haven't learned something.
No.
So.
Okay. The thing is, it's not a diff item, But the thing is, it's something you may want to look at. In other words, having a foundation, and what it really does, if it goes to your foundation, then as long as you abide by the foundation rules, it's a qualified charity, and use it to support your mission, which I believe the foundation is to support chess. I'm not sure. I never read your foundation articles, but then you could use the funds for whatever that is. From my recollection, you had to, in a foundation, spend at least 5% of the value of foundation every year for qualified charities. That was my reading a long time ago. And that's the reason the University of Texas at Dallas, when the guy who founded Texas Instruments contributed $50 million on death, they created those big chess scholarship funds. My quick analysis says University of Texas Dallas has $1.5 million a year coming in every year to support chess scholarships. Okay, so you could, that's what the foundation is there for. So it's something you're definitely going to have to consider. It's beyond the scope of what we're going to be discussing next week, which is conservation easements, and I'll have to work with Beckett to make sure he got the right link, conservation and captive insurance companies, but certainly something that you might want to consider looking at. That would be my.
Yeah. Well, one of the things that the Ead Foundation does is, for example, I was contacted by an intern that was working at the UN, and they were saying that Zambia has a youth program for soccer, for football. And so they wanted to expand it to something else. So I sent them chess equipment, set boards, and what have you. And so that's kind of the mission, is to send the people who want to play chess, let them have the equipment to play. And so, it's Zambia, it's Uganda, it's Nicaragua, and then now, COVID hit, and so I'm kind of on pause. But these are things that are not going to a charity necessarily. They're going to needy people, like an orphanage in Uganda. Right. That's part of my mission.
Yeah, right. Yeah, but I believe that would be a charitable expense. In other words, that would be my thinking without looking at the details of that. I also looked at that because I got a lot of books and things I wanted to donate to Uganda. And my problem was the cost of transporting it. It
Exactly.
exceeded the value. So I
Exactly.
didn't do it because I'm going like, it's
That was my first mistake.
yeah, it's going to cost me more to send it than the value of the book is worth. And Amazon didn't apparently drop in Uganda. So I was going like, it created a big problem. So
You know how I ship to Africa now?
I have no clue. How do you do it?
From China.
It's cheaper then.
Cheaper.
Really? Okay.
Way,
So I didn't know that.
way
Right.
cheaper.
Yeah, but then where do you acquire your stuff from? Is it from China?
Yes.
And then you send it from China to Africa.
Yes.
Right. Yeah, because I looked at the U.S. to Africa. It was just way too expensive.
And I did it the first time, once.
Right. Oh, U.S. once. Okay. Well, okay. I was really close to executing that transaction, so I could support the chess community in Uganda. But when I looked at the expense, I was going, there's got to be another way to cut this, because the cost of I think the cost of transporting a $15 used book was $79.
Yeah.
And I was going, I got to figure another way to get.
And you know what? When I got to Uganda, the first time I did this, I did it all wrong. The first time it went to Uganda, but they wouldn't deliver it unless you paid the Ugandan officials some more money. So yeah. I had to then send money directly to the guy in Uganda to pay the officials to get the goods.
Yeah, Sasha
from China, and there's no problem.
Yeah, well, we just went over in the earlier program today about Malaysia and their $2.9 billion apparently that Goldman Sachs kind of moved to
3.9, I think.
I see numbers from 1.9 to 2.9. They were raised billions for the Uganda.
3.9 billion.
I mean, for Malaysia, the billions for Malaysia to help them out their infrastructure, and then unfortunately the money got diverted in the nature of billions of dollars.
But you see, Malaysia already has pretty good infrastructure. So I think people who embezzled the money, US needs a better infrastructure, not Malaysia.
Yeah, but see, Sasha, until that came up today on IBM TV, I didn't even know that there was a big embezzlement going on in Malaysia to the extent of like $3 billion while we're out to sleep with coronavirus, you know. But my Malaysian friend alerts me to this, and I'm going, whoa. That's a big one. So
one very quick and naive question, obviously. Well, actually, a couple of questions. First of all, I've looked at the Canadian equivalent of IRC, and I couldn't find. They're all referring to U.S. Laws and regulations, but nothing in Canada. So I'm not sure even if we have something similar or not. Second of all, the use of land in Canada. Basically, there are two different uses of land. One, you're a landowner. Let's say you acquire the land and you can sit on it, pay taxes, and that's the end of story. And then you can build something on it or sell it and pay more taxes. And that's the end of story. There is second use of land. Traditionally, Canada was always in exploration business, whether it's gold, oil, or some other natural resources. Now, there, you can get a license to explore quite inexpensively. It doesn't cost you a lot of money up front. However, depends where the land is located, what province, and whatever else. You are required to retain the license and use the land, invest a set amount of money every year. It could be $5,000, it could be $100,000. It depends really where is the land located, what area, what province, and so on. So you cannot just sit on that license and see what else you can do. You have to start investing almost from year one. It could be a small amount first year, but it will be a bigger amount second year or so on. And if you are not going to comply with it, you just simply lose your license, and that's the end of the story. Now, the final question. Basically, everything what you've discussed so far only rich or relatively rich people, corporations, can really use it to their advantage. Mm-hmm. Now, most of the people obviously can't not only use it, can't even think about it at all. It's fact of life. So why then not to allow all the immigrants, whether it's Mexicans or from Europe or just from whoever, just come here to the United States and to Canada too, but to US, to what we're discussing now, because their first generation and even second generation, for sure, they're not going to use all this tax shelter to their advantages. They will pay their taxes, working mostly lower paying jobs.
Right.
So the states, whether it's California or New York or so on, they will get their fair share taxes. So economically, and that's how Canada qualifies, is that economically it's very good development for a province or a country. And what's the difference with US? Why US doesn't think so?
I think it's just bad policy. I mean, we went over that with our professors from on Business Monday. We had our professor from Southern Illinois and University of Illinois. The foreign students are coming in the United States, actually good policy. If we can retain the best and the brightest, and they do come here, and we could retain them. But the poor policy is it's almost like we bring the best and the brightest in, then we tell them to go back home. It's just poor policy in our immigration areas, Alexander. But you know, through the chess world, when we brought in the top players in the world in Webster University, University of Texas at Dallas, all these other places, we had our chess team one year win the Olympiad. I mean, we had the best chess teams in the world. It doesn't take much to figure this out, but on problem is we have politicians in Washington, D.C. that somehow don't understand that if we can recruit and retain the best and the brightest here, it'll make our country better. They just don't get it yet. So, and frankly, I'm not sure if they ever will. but the thing is, what can I tell you? I mean, if my policy would be, hey, look, if I can get the top Russian chess players on my team, I'm bringing them on, baby, and then we're going to win. Okay, rather than say, oh, come over here for a little while, then we'll send you back. That's ridiculous. But it's a policy. And I think that sooner or later the policy will change, but who knows? It may not. In the meantime, we do want to thank our special guest, John Power, CPA. Beckett Cantley, we missed you. We're not sure how that happened, but we're going to see if we can get you on next week. Jim Ead from the Ead Foundation also runs the TV show Chess Without Borders, and Alexander Starr, who runs our investment show on Wednesday, which we all love. Hopefully we'll have Shaquille on. And also tomorrow he's got a very special guest coming in from Ireland, who was a top player in what country? He was a top player in Russia. See, that's what I'm saying. The Irish are smart. Bring the top Russian players over, you know. And he'll be on tomorrow. What?
We call him Grandmaster Oberburn now.
Oberburn, yeah. But he's one of the top players in the world, is going to be on IBM TV, and realize there's only 1,600 grandmasters in the world. One's going to be on IBM TV tomorrow. There's 1,800 billionaires. So there's more billionaires than our chess grandmasters.
And please don't underestimate Ireland.
Don't underestimate Ireland. Don't estimate Ireland. Tomorrow on IBM TV. So we thank you all for watching, and we will see you tomorrow.